As we approach the start of 2026, the consensus among major financial institutions, including Goldman Sachs, Morgan Stanley, and JP Morgan, is one of resilient growth despite a complex web of geopolitical and inflationary risks. Below is a detailed breakdown of the 2026 market outlook across 4 key pillars. Macroeconomy. The soft landing solidifies. The global economy is expected to transition from a period of fighting inflation to one of sustained, moderate expansion. GDP projections. Global growth is forecasted to hover around 3.1% to 3.2%. USA, expected to accelerate to 2.2% to 2.6%, bolstered by manufacturing tax cuts and a resilient consumer base. China, growth is projected to moderate slightly to 4.5% to 4.8% as it shifts focus toward high-tech manufacturing to offset cooling domestic property markets and trade tensions. India remains the standout performer with growth likely staying above 6%, cementing its position as a primary global growth engine. The interest rate pivot. Central banks are expected to continue normalizing rates. The Federal Reserve is anticipated to target a terminal rate around 3.0% to 3.25% by mid-2026, providing a much-needed breather for corporate borrowing and the housing market.
Equity markets, the AI supercycle and market concentration. Analysts are generally bullish on stocks for 2026, with several major banks forecasting double-digit gains for the S&P 500, targets ranging from 7,500 to 7,800. Earnings overhype. While 2024 to 2025 was driven by AI potential, 2026 will be the year of AI productivity. Markets will reward companies that demonstrate clear margin expansion through AI integration. Broadening out. After years of Magnificent Seven dominance, 2026 may finally see a catch-up trade where mid-cap stocks and non-tech sectors, like energy and healthcare, benefit from lower interest rates and cheaper valuations.
Technology, from chatbots to agentic AI. The tech landscape is shifting from passive tools to autonomous systems. Agentic AI, 2026 is being hailed as the year of the AI agent. These are systems that don't just answer questions, but execute complex tasks, e.g., managing a supply chain or localizing an entire marketing campaign autonomously. Infrastructure spend. The power race continues. Huge capital expenditures, more than $30 billion, will flow into high-bandwidth memory, 3D stacking, and specialized AI chips. On-device AI, privacy concerns and the need for speed will drive a surge in edge AI, where sophisticated models run locally on smartphones and laptops rather than in the cloud.
Key risks to watch. Sticky inflation. While cooling, inflation may remain stubbornly above the 2% target in some regions, preventing central banks from cutting rates as aggressively as the market hopes. Geopolitical fragmentation. Trade barriers and tariff front-loading remain a wild card, potentially disrupting global supply chains and adding to input costs. Valuation skepticism. With the S&P 500 at record highs, any earnings miss could trigger significant volatility as investors question if the AI premium is sustainable.